Welcome to Personal Finance Simplified, the podcast that breaks down complex finance topics into simple advice for young adults. Hello, I'm your host, Ishika Chandra, and today is Wednesday, July 15th. Today, we're going to be talking about bank accounts. So, let's say you have some money laying around. You got something for your birthday, or maybe you work at a job. You could keep that money in your wallet or in a corner of your house. But then, let's say you forget all about it and come across it again 5 years later. Those $20 that you put into your wallet are still going to be $20 in 5 years. But you're going to be able to buy less with it because of inflation. Inflation, by the way, is when the price of something increases over time. Like, for example, 6 years ago, you could have bought 6 tanks of gas for $24, and now the same amount of gas is $36. So if you kept the $20 in your wallet, you would have actually been worse off because you would have been able to buy less. So you might be thinking, Ishika, what am I supposed to do with my money if I can't put it inside my wallet or in my house? I got you. Today, I'm going to be naming 4 accounts that you could put your money in, and I would suggest that you open each one of these accounts because they all have various usages. The first account that we're going to be going over is a checkings account. This is the account that you use for your everyday transactions because you can always take money or put money in it without any penalty. A penalty, by the way, is when the bank charges you a fee for you doing something in your bank account. For example, the bank could charge an overdraft fee if you tried to take more money than you have in your bank account. And in this case, I'm talking about the penalty that happens when you keep taking money from your bank account when the bank has explicitly stated that they don't let you to take money from the bank account. However, checkings accounts let you take money from the bank account as many times as you would like. So theoretically, you could take money from your checkings account every single minute and they would not charge you a penalty. Because of this, you can use a checkings account for debit cards, checks, and transferring money to other people or accounts. So if you have money coming in from a job, you would typically tell them to directly deposit your paycheck into this account because you can use this money whenever you would like. You can also use this account to pay your bills instead of using a credit card. But just make sure you have enough money in this account to pay the bill, or you may have to pay a non-sufficient funds fee, which is when the check bounces because you don't have enough money to pay for the check. This would typically result in you having to pay $25 to $30 to the bank. Because you're able to take as much money as you would like whenever you would like, the checkings account typically gives you zero to little interest. And by the way, interest is like when you have money in the account and the bank pays you a percentage of the money in the account in order for you to keep your money in their bank. So for example, if you have a 1% interest rate per year and you have $100 in a bank account, you would make $1 the first year. And then in the second year, you would make $1.01, and so on and so forth. So when you're searching for a bank that you want to create a checkings account, or really any account in, look for banks that offer the highest regular interest rate or compound interest rate. I would suggest you put no more than the minimum you need for your rent, bills, and daily expenses in the checking account because you're not likely to make any additional money from it. Typically, you should put around 60 to 70% of your paycheck in the checkings account, but this percentage may vary depending on your situation. The second account that I'm going to be talking to you about today is a savings account, which is mainly for emergencies. You can withdraw money from it whenever you want, but some banks have a limit to how many times you can withdraw money per month. So it's not unlimited like the checkings account. So if you did take money from the bank account like every single minute, they would charge you a fee. However, you do get higher interest rates in order to incentivize you not taking money from the bank account. On average, you get around 0.61% interest per year from a savings account. However, there are high-yield savings accounts which offer you up to 4% or more interest rates. So make sure to research the interest rates at each bank that you are considering starting a savings account in and look for a high yield savings account. Typically, you should put around 10 to 15% of your paycheck in a high yield savings account because it isn't that restrictive and you will make good interest or money off of it. This money should be used to pay for your emergency fund and short-term savings. But again, if your expenses are really high in a certain month or really low, you should adjust this percentage. The third account that I'm going to be talking to you about today is the money market account, which is basically a combo of checkings and savings accounts. Similar to a checkings account, you can use a debit card and a check with this account, and some banks even offer you a debit card and a check when you sign up for this account. But in order to avoid fees, you need to make sure that your account balance stays above a certain amount. So your bank might ask you to keep your bank account above a certain amount. For example, they might ask you to keep your bank account above $1,000 at all times. However, if you do withdraw money and it somehow dips below the $1,000 or whatever the bank says the minimum amount is, you will be forced to pay a fee to the bank. This is similar to a savings account. You can also get an interest rate of around 3.9%, which is similar to a high-yield savings account. I would suggest putting around 10 to 15% of each paycheck inside of a money markets account because you will make quite a lot of money off of it. The purpose of this account is to create a larger emergency fund. So just think that whatever money you put into this account is going to be accessed in 1 to 3 years and is not something you can access for your everyday expenses. Again, you should adjust this percentage for your situation. The final account that I will be talking to you about today is the certificate of deposit or CD. Essentially, you put your money in this account and you can't access it for a certain amount of time, typically 6 months to 5 years. And if you successfully don't touch the money throughout this term, you can get really high interest rates, up to 5%. But if you do touch the money in this time period, you will have to pay a penalty, which is just a percentage of the money that you put into that account. So I would suggest putting the money that doesn't go to your bills and emergency funds here, but making sure that whatever you put inside of this account, you for sure don't need for whatever term you sign up for. Typically, you should put around 5 to 10% of each paycheck inside of a certificate of deposit because this will function as an investment that you will make 5% or more interest on each year. However, you need to make sure that the money that you put inside of the certificate of deposit is money that you for sure won't need until the CD matures. So if you are unable to invest that much, then invest less than 5%. However, I do suggest you put at least a little bit of money in the CD each month because it is essentially free money since you will be making a lot of money off of just keeping the money inside of the account. So to summarize, a checkings account is for day-to-day activities, a savings account is for an emergency or saving up for a small big thing, such as a vacation. A money market account is for money you won't need for the next 1 to 3 years and is a bigger emergency fund. So for example, if you want to pay for a car. A CD is for money you for sure don't need until the time is up. The general rule of thumb for remembering these accounts is that the more you don't touch the money, the more interest you will get. I would suggest opening each of these accounts and dividing your money into these following percentages. A checkings account with 60 to 70% of your paycheck, a high-yield savings account with 10 to 15% of your paycheck, a money market account with 10 to 15% of your paycheck, and a certificate of deposit with 5 to 10% of your paycheck. However, I would suggest keeping your own situation in mind when you're planning these percentages out. If you plan on buying a car in the next few years, then I would suggest increasing your percentage that you put in a money market account or a certificate of deposit so that you can make sure you make enough money for the car. Additionally, make sure to research all of the banks that you are considering for their interest rates and benefits for each account that you are interested in getting. And don't go to the first bank that you see. Good luck, and I'll see you guys next Wednesday.